Okay.
Good morning, everyone. Go ahead, Sandra.
Good morning. Welcome to another wonderful webinar that we're going to have today with Teddy. And I welcome everybody. Just want to say that I'm very happy to have her to give us the classes today because this is an amazing webinar that we're going to keep learning about accounting. And then go ahead, Teddy. Welcome everybody, and then we'll start the class now. Thank you.
Okay, thanks for being here and thanks for having me. I appreciate the time. Today I'm going to be talking about cash flow planning using your business and some important information about the money and what you can expect when you own your own business. So I'm going to start by sharing my screen. So here's a little bit about me. So if you haven't been on my other two webinars, my name is Teddy Decker. I'm a CPA and have been a CPA for going on 30 years now. I've had my own business, Double Decker Consulting, for the last 13 years, more or less. And very happy to be here. I do mostly income tax planning, small business consulting, and bookkeeping in my practice. Today, specifically, we're talking about cash flow planning and some very important aspects, a few different aspects that maybe you might not have heard about before, but that are very important to keep in mind. So here's my little legal disclaimer. Some of the information that I give might sound like legal advice, but just keep in mind I am not a lawyer. And so if you need specific legal advice, make sure you contact a lawyer. I do not give legal advice. Today, let's start off by talking about what different types of taxes there are. There's often a lot of confusion about the different aspects of taxes because taxes isn't just one thing, it's multiple different types of taxes. And just because you've paid one of them doesn't necessarily mean you're out of the woods for all the others. We have in New Mexico several different types of taxes that we can pay. If you're an individual, a sole proprietor, or a single member LLC, for income tax purposes, you're all the same. There's no difference between individual, sole proprietor, and single member LLC. There might be legal differences. There are legal differences in those structures, but for income tax purposes, those are all going to be the same. And in all of those cases, the individual, so the business owner, pays all of the taxes out of their pocket. When you're a sole proprietor or an individual and a single member LLC, there's basically no real difference financially and income tax wise between the owner and the company. If the company doesn't make enough money to pay all the taxes, guess what? It falls on the owner's shoulders, and the owner will be responsible for making sure that stuff gets paid, regardless of whether the company has the money to pay it or not. So you want to make sure that you're watching these taxes and putting aside the money that you need to be able to pay the taxes. There's income tax. These are the normal taxes that you hear about all the time. Your 1040 income tax return that is filed at the end of the year, and it is on both the federal and the state. In New Mexico, we have income tax. There are a few states in the country, Texas, Alaska, Tennessee, Wyoming, and Washington, and Florida. I believe that's all of them, where they do not have a state income tax. So they have other taxes in the state, sales tax, property tax, that kind of stuff, but they don't have state income taxes. So if you live and work in those states, you probably don't have a state income tax return to file. Oh, Nevada's another one, but you do have federal income taxes that still have to be paid. And then all the other states besides those that I listed, you also have state income taxes. And the state income tax rate can vary widely depending on what state you live in. California, New York, New Jersey all have pretty high income tax rates. There might be upwards of 8 to 10%. In New Mexico, our average income tax is about 4.5, between 4.5 and 5%, depending on your income. In New Mexico, we also have a gross receipts tax. So gross receipts tax is essentially a sales tax. However, it is charged to the seller, not the buyer. So the seller can opt to charge that gross receipts tax through to their clients, but it is not required. And the state doesn't care whether you charge it through to the client or not. You are still responsible for paying those taxes. So this is a sales tax, and not only is it added on to things that you sell, so tangible goods, a computer that you buy, or clothes or whatnot, but it also is added onto services in New Mexico. And this is unusual. Most other states do not charge a sales tax or a gross receipts tax on services that are provided. So if you purchase, my services as an accountant, if you go to the doctor, a lot of times you have to pay gross receipts tax. If you hire an attorney to do services for you, if you hire a plumber to come in and they don't have any supplies that they use, they're just charging you for their services, they're probably going to charge you gross receipts tax as well. Similar, if you provide those services, you want to make sure that you are not only charging the customer the gross receipts tax amount, but then that you turn around and remit it to the New Mexico Taxation and Revenue Department properly, because you can get in big trouble for not getting those all filed. And then we also have our self-employment tax, also called FICA. So this is Social Security and Medicare. And if you are an individual, sole proprietor, single member LLC, you pay your self-employment tax with your personal income tax return at the end of the year. So it can get very confusing, because technically this is a completely separate tax that is being paid, but it gets combined with your income tax return. So it can be confusing, because it looks like maybe you pay a very high amount of income tax, when in fact you might not be paying any income tax at all. It might all just be the self-employment or FICA tax that is due. In addition, when you're an individual or sole proprietor, you pay the employee share as well as the employer share. So you have basically twice as much. If you work for somebody else and you don't have your own business and you're paid on a W-2, then your employer typically pays half of your Social Security and Medicare, and you pay half of your Social Security and Medicare that's withheld from your paycheck. When you're self-employed, you have to pay both sides of that and into the government. I'm going to talk just briefly about the timing of these. So income tax is typically paid once a year, depending on how high your income is. If you're self-employed, you may also make quarterly estimated tax payments. Keep in mind, those are estimates that are paid throughout the year. They're paid 4 times throughout the year. Since you don't have a W-2 and a paycheck, then the income taxes have to be paid in periodically. And so you would pay it in quarterly, but it's still only one income tax calculation at the end of the year. The amounts that you prepay are all just estimates. And then at the end of the year, when you do your tax return, you true it up and say, okay, we paid this much, we owe this much, and either you get a refund or you owe a little bit more to pay in to true it all up. New Mexico gross receipts tax, there again, depends, the filing and the paying on this one depends on how much you are earning and how much tax has to be paid. The minimum amount of filing for New Mexico gross receipts tax is semi-annual, so twice a year. You have to pay in July for the first half of the year, and then in January for the second half of the year. They also could be quarterly or monthly filings and payings, depending on how much you're earning and paying. And then the self-employment and FICA taxes, since this gets wrapped up into your income tax return calculation, most likely you're paying this at the end of the year when you file your tax return, or as part of those quarterly estimate payments that I mentioned before. Now, if you are an S corporation, the tax situation is a little bit different. So with an S corporation, the owner is an employee of the company, and the owner actually gets a paycheck and a W-2 just like any other employee. So in this case, the business will pay the FICA and payroll taxes. So the S corp is going to be, oops, back. Okay. So the S corp will pay the FICA and payroll taxes. Since if you're the sole owner of the S corp, then it's still the same. You're paying the employee and the employer portion of the payroll taxes. It's just that it's being paid from the company bank account instead of from on your personal tax return at the end of the year. And then the S corp would pay the New Mexico gross receipts tax, or if there are other state sales taxes out of state. And then the S corp does not pay any income taxes in this case. It still passes through all of the net earnings from the business onto the owner's personal tax return, and then income taxes paid at the personal level for that. In addition to the wages that are paid on a W-2 that also get passed through from the S corp. And the owner would pay the income tax on all of those. And just like with the individual sole proprietor, the owner may be responsible, may need to make those quarterly estimated payments depending on how much net profit is coming through on the S corp. Because keep in mind, no tax is being paid on that. On the W-2 wages, there would be some withholding on there, so you're getting some estimates paid in throughout the year, but not on the additional net profits of the S corp. I also like to mention that on the S corporation, keep in mind that it does not matter whether you distribute, and same thing with the LLC and the sole proprietor. It doesn't matter if you distribute the money out of the business bank account into your personal bank account or not. You still are taxed on that for income tax purposes as the owner of the business, because the business doesn't pay its own taxes. All of the earnings come through to you. So you can take out all the money, extra money as a distribution out of the business bank account and put it in your personal bank account, or you can take none of it, but you're going to be taxed on the net profit of the business, regardless of whether you distribute it or not. If you have a partnership or a multi-member LLC, those are taxed the same way as each other. In this case, the partnership would pay the New Mexico gross receipts tax that's due. And if there are other employees, so not the business owners, then you would pay FICA or payroll taxes for the employees. And owners of a partnership do not take W-2 wages. I've seen this partnership set up where they pay the owners with a W-2, and that is incorrect. The IRS does not like it when you do that. The owners should not be taking W-2 paychecks from a partnership. If you want to do that, then you need to elect to be taxed as an S corp, and then you can pay the owners on a W-2 on a regular paycheck. And then the owner, and at the end of the year, will pay FICA or self-employment tax on guaranteed payments. So guaranteed payments are kind of like wages or out of the partnership. It's payment for services provided to the partnership. So as a business owner, you can be paid for two different things. You can be paid because I worked in the business and I want to be reimbursed for my time and the amount of work that I'm putting into it. Or you can also just be paid because I own this business. I started it and I make sure that everything stays running smoothly, but I'm not actively working in the business. Maybe I put up the money so to hire the people to be able to run the business or whatever, and I want a return on my investment. So I can get a distribution just because I own the business, regardless of whether I'm working in there. And so if you have a partnership, in that case, guaranteed payments would be, I worked in the business, I provided services, and I want to be reimbursed for that. Whereas the other payments, the distributions for just return on investment, would not be necessarily related to how much work you put in there. And then you pay self-employment tax on those guaranteed payments, and that gets paid on your personal tax return. And then just like in the other, the single member LLC and the S Corp, your percentage of ownership of the net profit of the business is also subject to income taxes. And then lastly, we have corporations. So a full C Corp, in this case, the corporation is its own entity. It pays its own income taxes. So you would have the New Mexico gross receipts taxes, which the corporation pays. Any FICA payroll taxes are paid by the corporation. So employer and employee portions are there. And then federal and state income taxes are paid at the corporation level. So with a corporation, it's a little bit more difficult for the owners to get money out of the business typically. Typically, the main way to do that would be on a W-2. But in the case of a corporation, you cannot or should not take distributions to the owners. So if you're taking money out of the corporation, it's either going to be because you have a paycheck. Sometimes the corporation will rent space from an owner. So if I own a building or I want to have the corporation run out of my house, I might rent a space to the corporation and the corporation would pay me rent, which I then have to pay income tax on the rent income for that. Or you can have the corporation pay dividends, but dividends are not such a great thing for income tax purposes because the dividends are double taxed. The corporation does not get to take a deduction for the dividends, but you still have to claim it as income on your personal tax return. So it gets taxed at the corporate level and then again at the personal level. So it's not necessarily such a great way to do that. And then when you have a corporation, pretty much the only tax that you would pay income tax on are W-2 wages. And then if you take dividends, then that would count as investment income that you pay tax on. Okay, so I've got all these different taxes that I have to pay. And you need to consider when you're a business owner, your marginal tax rate. So if I'm in a simple case, if I work for somebody else, they pay me on a paycheck, I get a W-2, they withhold tax from my paycheck, it gets paid in all year, and I get, say $1,000 a month deposited into my bank account. I know that I can spend $1,000 a month on all of my personal bills, my mortgage, my food, my rent, whatever it is that you're paying. That's all money that's left over for me to pay. With a business owner, the situation is a little bit different because you have to take into consideration these taxes. So if I have $1,000 from my business at the end of the day, I then have to subtract. So business, you have the gross amount. So sales up here, maybe it was $5,000 and I have $4,000 of expenses on the business. So now I'm back down to that same $1,000 that I would have earned on my W-2, my net amount. However, no taxes have been paid on that yet. So we have to take into consideration what our marginal tax rate is to figure out if we are earning an equivalent amount, or if we want to know, I need $10,000 a month net to pay my bills, my mortgage, my food, pay for kids' college, all the rest of that, then how much do I need profit do I need from my business in order to support that? And that's where the marginal tax rates come into play. And it's very important that you know what your marginal tax rate is. So your marginal tax rate in the United States, we have a graduated tax system. And so what that means is if it was a flat tax system, then it'd be super easy because your marginal tax rate would be the same thing as the flat tax. So if it was 5% across the board, you would always know it's always 5%. With a marginal tax rate, what that means is I get taxed, so up to a certain dollar amount, there's 0 taxes charged. And then up to the next level, it's 5%. And then up to the next level, it's 10%. So each different step increases your tax a little bit. And in order to figure out your marginal tax rate, you would take the total tax amount, not the amount that you pay or get refunded, but your actual tax dollars calculated on your tax return, and divide that by your income. And that'll give you your blended marginal tax rate to tell you what you need to have. So once you get your percentage, then you can back into how much do I need to have my business profit be in order to net out a certain amount. In the United States, your federal tax, your marginal tax rate totally depends on your earnings. So the average, in my experience, is between 10 and 25%. It just depends. If you're a very high earner, over $200,000 or $300,000 a year, then it's probably going to be higher than that. If you have not very much income or your business has a net loss, then it might be a little bit lower than that. But in general, for most people, we can use somewhere in the 10 to 25% range. Although that's a pretty big range in itself too. So that's why it's important to calculate this for yourself. Get your last year's tax return. If you're just starting up your business, then you can do estimates of how much you want to earn, how much you really think the business is going to earn, and then we can use that to calculate what your marginal tax rate should be. And then in New Mexico, our tax rate is around 5%. You're generally between 4.5% to 5%. 5% is about the maximum, the highest tax rate that we would see. And then here again, as I mentioned before, other states, it varies widely. So if you're doing if you're living in another state, or you're going to move to another state, or you're going to do a lot of work in another state, then you need to find out what the tax rate is there, so that you can put that information into your calculation and not be surprised at the end of the year if you owe a bunch of tax in another state. So I don't want to get into it too much, but I want to talk just a little bit about doing work in other states and what's called nexus. So if you have a business and you are going to be doing work in another state, you want to find out what that state's nexus rules are. So nexus means, when do I have to report income and pay tax in another state? So my business is here, but I'm going to have a big sale, or I have a lot of customers in Arizona because we're close by. And so I'm going to go over there and do some work. You want to look up the nexus rules and see, okay, at what point do I need to start filing and paying taxes in that other state? The United States has probably 1 million different taxing authorities. The states are going to be the first level, and then within each state there are counties and cities. Just like in New Mexico, we have a couple of hundred different taxing areas for the gross receipts taxes. Other states have that as well. In addition, there are some cities that also have an income tax in addition to the sales tax. So New York City, Chicago, There are a couple of others where the city actually charges an income tax as well. So make sure if you're doing work in another state, in another city, and you're doing a fair amount of work, if it's just a one job, maybe a few $100s or even a few $1,000s, you probably don't have a problem there. But make sure you do some investigation before you do a significant amount of work in any other state or city. And check with your accountant or an accountant in that area to make sure that you're not going to get into trouble and have a surprise tax later on, which nobody likes to have. So then in addition to, so these are just marginal income tax rates. So this is just strictly the income tax. We talked about the different types of taxes at the beginning. We also have additional taxes. So Social Security and Medicare, this was the FICA. Or self-employment taxes. This is 15.3% is Social Security. Technically FICA is, so Social Security and Medicare tax, which adds up to 15.3%. That's the employee and employer portion. And this is based on your business profit for a Schedule C if you're sole proprietor or single member LLC. Just your W-2 wages if you're an S Corp. And then the tax rate is 15.3 up to 168,600 of earnings. So if you have a Schedule C business and you earn $200,000 on net profits, you will be charged the 15.3% on 168,600. And then the additional amount, you'll still be taxed for Medicare, which is 0.3 more or less, is 0.29% of additional Medicare on that. So just be aware of those self-employment taxes. There's also net investment income taxes. This is 3.8% for higher earners. So if you're single, it's over $200,000, married filing jointly, $250,000. So keep in mind, there's a pretty big penalty on this one for married filing jointly. If your total combined income for you and your spouse is over $250,000, you're gonna fall into this additional net investment income tax. And we need to take that in consideration with the marginal tax rate. We have additional Medicare tax. So there's Medicare tax on all of your earnings, but then additional Medicare tax. So another 0.9% if your earnings are over $200,000. And then we also have the alternative minimum tax, which is it comes into play at 85,700 for single taxpayers and 133,300 for married filing joint taxpayers, which a lot of people, this used to only be for very high tax, very high earners. And nowadays that's not necessarily that much money. So we're seeing a lot more people that get subject to the alternative minimum tax. I don't want to go into great detail about what the AMT tax is, but let's just say it's an additional tax calculation where you do a calculation on your taxes in a normal, just ordinary way. And then we take, there's basically a whole different set of rules, and we do a recalculation based on the AMT rules. And then we compare them, and you have to pay whichever tax is higher. So there are some people that fall into that range, but hopefully not most of you. And even a lot of people that do fall into the alternative minimum tax income tax ranges don't have too much AMT adjustments, which are some of the special calculations that are done. Even if you did an AMT calculation, it might come out exactly the same as your ordinary income tax calculation. So as you can see, there's a whole bunch of different taxes that you have to take into consideration. And that's why I usually recommend that you take last year's tax return and just do a calculation. It's way easier to take last year's tax return, look up your actual income tax total income tax, divide that by your total income to get your more marginal tax rate, as opposed to trying to go through and become an expert on all of these additional taxes and all the different moving pieces and try to figure that out. This is why CPAs and accountants go to school for a really long time and have to continue their education so that we know how to calculate all these things. It's very specialized knowledge that the average person generally doesn't have. So at the end of the day, we did our calculation. We just did the simple calculation, total taxes divide by total income on the tax return to come up with our marginal tax rate. And we've figured out our marginal tax rate is 40%. So this is all our self-employment taxes. This is all our income taxes. This does not, now keep in mind, this is just income tax side of things and income tax return side of things. This does not, oh, and then gross receipts taxes, all of that. Then we can put in here and say, okay, I need to have $10,000 a month at the end of the day that I can spend on my personal things. I want to take $10,000. In this case, my example is I want to pay off $10,000 of debt, but maybe that's, you know, I want $10,000 of income to pay off my credit cards and pay off my student loans and make my mortgage payment and pay for food and utilities, all that kind of stuff. So I need $10,000 of net cash at the end of the day. So how much net profit does my business need to earn in order to provide that? And the answer to that is about $16,700, and that's with your marginal tax rate of 40%. And so if we take the $16,700 and take our 40% off, so 6,700 is more or less 40% of 16,700, then that leaves us the $10,000 that I can take money out of my business to pay personally. And the other 6,700 needs to be put in savings or paid out to the government directly. So either put it in savings so that you have it available to pay your taxes at the end of the year, or go ahead and pay it to the government as estimated payments. So the important thing to remember here is, as a business owner, you can't necessarily compare apples to apples when you look at a paycheck and being paid as an employee by somebody else, because you have to take into consideration your marginal tax rate and these additional taxes that are going to have to be paid. This is the same reason why if you hire contractors as opposed to W-2 employees in your business, then you would typically pay a contractor more than you would pay an employee, a W-2 employee, because the company is going to be responsible for paying some of the expenses. And so at the end of the day, the cost to your company might be the same, but the gross amount that you're going to pay your employee versus your contractor is going to be different. The contractors would typically get paid more because they're responsible for paying their own income taxes. I mean, their own self-employment taxes and other costs. Okay, let's talk about actually budgeting. So now that we've come back to, okay, I know that I need 16,700 net on my business each month so that I can pay myself $10,000. The rest is going to go to taxes. So I need to come up with a budget for my business to say, okay, how much now? Let's back into the gross amount. I need how much in sales in order to support that. So business, so how much do you get to keep at the end of the day? So we have our gross income up here. So this is my sales. I'm either selling stuff or my time or, you know, however the business makes money. That's your gross amount. And then you subtract out all of your business expenses. So all of your day-to-day stuff. If you saw my previous presentation, we went into great detail about what types of business expenses are legitimate and you can claim against your business income. And then we subtract out the taxes. So this is our 6,700 up here, or the 40% in this case for your marginal tax rate. That's why it's important to know what your marginal tax rate is. Whatever's left over, that's yours as a business owner. If you are in a partnership or S Corp and you have multiple owners, then you might have to share what's left, what's yours with whoever the business owners are. So keep in mind, if you only own 50% of the business, then it may only be 50% of the net that is yours and that you get to take home, depending on what your agreement is with your partners. And then, so that gets you back down to what's your break even? So where do you need to be? And hopefully your business will earn even more than what you actually need and you can shore up. Okay, let's talk a little bit about fixed and variable costs. So in your business, you typically have fixed costs and you have variable costs. Variable costs are things that will change depending on how many sales you have. So if you make widgets, then you have to buy the supplies to make the widgets. So the more widgets you sell, the more supplies you have to buy in order to make more widgets. So it's a variable cost. It directly relates. If I want to sell one widget, I have to buy one supply. And if I want to buy sell 10 widgets and make 10 widgets, I have to make the supplies, buy the supplies to make 10 widgets. So direct correlation. Then we also have manufacturer. If you're a manufacturer or a service provider and you have employees, then the employees' wages would be variable costs. And because same thing with manufacturing. If it takes employee A, Joe takes 5 minutes to make 10 widgets, then it's going to take him 50 minutes to make 100 widgets, theoretically. I know it's not exactly linear, but more or less. So the more widgets he makes, the more time it's going to take and the more wages we have to pay them. Those are all examples of variable costs. Some people pay commissions, real estate agents, for example. If you're selling a house and it's based on commissions, the more houses you sell, the more the commissions are going to be. So that's going to be a variable cost as well. Then we have our fixed costs. So to large extent, a large portion of the expenses from a business are going to be fixed costs. And these are things that we have to pay regardless of how many sales we have. It doesn't matter if we sell one item in a month or we sell 500 items in a month. This cost is going to stay the same. So the rent for your office space, if you rent manufacturing space, there could be or if you need to grow and have more employees, there could be a variable portion of rent. But for the most part, rent, you've got an office, you're paying rent, and it's fixed. You pay the same amount regardless of how many sales you have in that month. Most insurance, so liability insurance and equipment insurance, that's all going to be a fixed cost. The insurance costs what it costs. The exception to that is workers' comp insurance, which is often tied into the amount of wages that you pay. And so if you're paying more in wages, you might be paying more in workers' comp insurance premiums as well. Property taxes are fixed. They're based on the property itself. Things like office supplies, meals and entertainment, a lot of that stuff are not only fixed costs, but they're also discretionary costs. So those are the type of items where you might have more discretion as to whether or not you can afford to pay that in a month, and where you can have some wiggle room to get through to make your budget work. If you need to cut costs in a particular area, you want to look at which things are mandatory for the business and which things are optional, and maybe we could cut back on some of those fixed costs. Okay, so here's just a picture that demonstrates a graph that demonstrates the difference between our variable and our fixed costs. So our fixed costs are going to stay the same. Doesn't matter what quantity is produced. If we produce 1 or we produce 1 million, the fixed costs stay the same each time. And then with our variable costs, the more production we have, the more sales we have, the more those costs are going to increase. It's important to know which are your fixed and which are your variable costs, and have a good idea what is my business spending money on. There are a lot of people out there that don't necessarily look at their profit and loss, their financial statements, and can get into trouble because they just spend money based on, okay, how much money is in my bank account, and they go out and spend it. And then at the end of the year, either you have a large thing that needs to be bought, or you have to pay income taxes and you don't have the money for it. So make sure you have a budget and a profit and loss statement and know what you're spending money on, which items are variable and which are fixed costs, what things you have to have, which things can potentially be cut back or aren't needed at all. Do you even have a profit and loss statement? There again, refer back to my previous presentation. We went into great detail about financial statements and looking at a profit and loss statement. Is it relevant for your business? I would argue that a profit and loss statement is relevant for every business. Every business, even if it only has 3 items on it, you should still know what they are, and you should still have a good idea and follow this over time. And then, is it accurate? With any financial reporting, actually any reporting at all, if it's garbage in, garbage out, you need to make sure that the information that you put into your financial statements is correct, and that you're not fooling yourself. It's far better as a business owner to look at the brutal truth of your profit and loss statement and be able to do something about it than to have information that isn't as accurate and maybe paints a rosier picture, but at the end of the day, your business is going to go under because you're not being truthful. I would far rather know about it up front and be able to try to make changes than to fool myself into thinking that everything is rosy when it's really not. There are a lot of software programs out there that can help you create a profit and loss statement. QuickBooks is probably one of the de facto standards for the accounting industry, and will work for most businesses. There are also options out there like FreshBooks and Xero that are free. And then even just a spreadsheet is better than nothing if you can, if you have a pretty basic structure. The things like the accounting packages like QuickBooks will also help you make sure that all of the information gets entered into your books. It has things like bank reconciliations, and there's some checks and balances to make sure that everything is happening correctly. I usually recommend that every business owner at least know and understand how to do their bookkeeping. Even if you don't want to do it on an ongoing basis, you should at least be able to do it. If you hire a bookkeeper, that's fabulous, great. But make sure, we call it the bus contingency, that you should be at least able to step in and do it if you had to. If something happened and your bookkeeper got hit by a bus, or you couldn't get a hold of your accountant for whatever reason, then you would be able to step in and make sure that things continue to run, your bills get paid, and you know where your financials are until you can get somebody else in that position. Let's talk about specifically cash flows and budgeting. Do you have a budget? So the first thing to do is create your profit and loss, make sure that you have good, accurate financial statements. And then the next step would be actually creating a budget for the next year. You want to make sure that you're taking a look at that because it gives you targets, just like in our personal lives and our business lives. Externally, it's good to have goals and look at the future. Where do I want to be? What is my plan for my business? Do I want the business to be able to support me so that I can quit my day job? Have I already quit my day job and I'm just running the business? And now I need it to support me. How much money do I need it to bring in? How do I know if I'm on target or not? And that's where the budget and the cash flow projections come into play. It's very important to have this information, even if it's not in extreme detail, at least a general idea. And it's usually the best idea to actually write it down so that you know. It doesn't have to be set in stone. It's a flexible document, but it's a good place to start and get something written down. When we're making a budget, we usually recommend, if you've been in operations already for a year or two, it's a good idea to start with last year's. Say, okay, this is a super easy way to do it. If you have a chart of accounts set up already, start with your chart of accounts and say, what did we do last year? Let's take last year's numbers and round them off. And that's where we're going to start for this year. That's a good starting place. If you know you're growing, then you can add in just a percentage. Oh, I want to grow, 5%, or I think that's really reasonable that I can grow, or we have been growing 5% a year for the last few years. So I'm just going to automatically add 5% to most things. So our variable costs, our income amounts. Now, and here's where you take a look at the fixed costs. Hopefully are staying fixed. I know we've had some pretty severe inflation in the last several years. So it could be that you add in, some amount just for inflation because you know that it's going to index and be a little bit more. If you have a 5-year rent agreement in place, then you might know, oh, in year 2, then the rent increases by X dollars, or in year 5, if you have that information and you already have some contracts in place, then you can add that information into your budget after you've got the initial one started. It's also important to have personal versus business budgets. So the business should have its own budget, and then hopefully the business is providing enough income for you personally. And then you can have a personal budget as well. And how much do you spend on a personal level? How much do you need to pay your mortgage or your property taxes or food or all of that kind of stuff? And just like with the business budget, a good place to start with a personal budget is, what did we do last year? Where did we start with last year? And then how much do we need this year? Is it increasing? Are we moving? Did we have another kid? Do we have a kid going to college, et cetera, et cetera? Take into consideration all the things that you know about your life that might be changing, and then put that into your budget. And then hopefully the business budget is enough to feed into the personal and support you. We usually recommend at least a 12-month projected budget. There again, like I said, you can start with what happened last year. We usually do them on a calendar year, but it doesn't have to be. If you know that you're in retail sales and you're always crazy busy at the end of the year, maybe you want to do a budget that runs from June to May. Or something like that, where you've got more time to fiddle around and play with those budgets and get it in place for the next year. So most typical is going to be on a calendar year, and you don't necessarily even have to project it out by month. You can, but you could also even just do an annual budget and then just know that you want 1/12 of it in each month, more or less, if things are fairly smooth. If you know that you have a busy season in your business, then your budget should not be exactly the same for all 12 months of the year. You should have, a higher income projected during your busy months, your busy season, probably more in expenses during that time period as well, and then with slower time periods. And knowing those trends in your business will help you for cash flow as well, because if your busy season is right at the beginning of the year, for example, you might know, okay, I need to leave extra cash in the business bank account because we're going to have a slow period in, July, August timeframe when we need extra cash to cover our fixed expenses because our income drops and we don't have as much. So having that budget in place will help you determine all those things. Then how much should you keep? What is your business bank balance? Best practices to have at least 3 to 6 months of operating expenses in your business bank accounts. This could be in your savings account, and that way, if you have some of those slow periods, or we get another COVID and something unexpected happens, you at least have a few months of wiggle room that you can keep your business operating while you make some decisions about, do I want to keep the business open? Do I want to shut it down? Do I want to change things up? Do I have, some extra money to be able to put into place the pandemic restrictions and getting masks or getting people to work online? Maybe there's some extra expenses for setting up systems for some of that kind of stuff. So if you have some extra cash typically saved in your bank account, then that shouldn't be a problem to do that. And it just gives you that little bit of extra security and wiggle room if there is something that happens and goes wrong. And be your own line of credit. So here again, if you have a busy season and then you have a slow season, you might, during the slow season, draw on a line of credit. However, if you've got several months worth of operating expenses already in your savings account, then it's not that big of a crisis, because you can borrow the money from yourself and then build your line of credit back up again when you get to your busy time again. And then you're not having to pay that interest expense to a bank. Instead, you can finance it yourself. And then keep in mind, are you current? Are you robbing Peter to pay Paul? Are you working on a project and you're still paying off the credit card statement from the last project because the last project didn't make enough money to cover itself? You want to make sure that you're always hopefully going forward and making more money than what you need for your current expenses, so that you can build up that balance in your of additional operating capital, and not have to borrow money from the banks. So we use a method that's called the small plate method. And this comes from a book by a gentleman named Mike Michalowicz called Profit First. That is an excellent, excellent book. If you want to get into a lot of the details around this method, I highly, highly recommend the book. And there'll be a lot of details and all the step-by-step information in there. It's called the small plate method because it goes to the theory. It's a dieting theory, actually, where if you use a small plate to put your food on, it fools your brain into thinking that you're eating more, because your plate will look very full. Instead of, if you have a big plate and you just put a little bit of food on it, then your brain doesn't think you're full at the end of the day, even though it's the same amount of food. And so in this method, we do the same thing with cash in bank accounts. So you start by opening up several different bank accounts, And you have one where all of your income goes into one bank account, and it could be a checking, it might be a savings account on that case. And then you have a bank account for operating expenses, income taxes, owner's pay, profit. You can have as many different bank accounts as you want, and you can also start with a smaller number of bank accounts. So this is a very flexible method, and you kind of have to tailor it towards your business and how your business operates. And then when the money comes in, and you can do it on whatever frequency makes sense for your business. If you get the majority of your deposits at the beginning of the month, for example, for like billing from the previous month, then you might only do an allocation once a month. But if you have a constant flow of income into your bank accounts, you do retail sales and they're fairly even throughout the month, then in that case, you might do allocations once a week or twice a month. You just kind of have to get a feel for your cash flow, and then make the allocations based on that. And so the money would go into one account, and then we're going to take a percentage of that and transfer it to our operating expense account, our tax account, our owner's pay, and our profit account. And we would calculate these percentages ahead of time. So we know, okay, I know owner's pay, I want to have 10% go to me. I know that my operating expenses are 40%. I'm going to put 10% in tax, and then the rest of it's going to go in profit. And so you have to know your financials ahead of time in order for this to work. But then what happens is every time I get income, I know what percentage should go into operating expenses. So when I go to pay bills, even if I have income that fluctuates up and down and up and down, I should still have plenty in my operating expenses account to always cover my operating expenses and always cover my owner's pay. We're all in this, if you have your own business, only like very, very small percentage, like 1% or less of people actually start a business because they think it gives them a tax write-off and they want it to have a loss. For the majority of people, if you start a business, it's because you love what you do and you want to be independent and you want it to make a profit. If you have a business that makes a profit, that's the goal. That's a good thing. And it's also a good thing if you owe tax, because that means you're making a profit. You just want to make sure that you're planning for it and aware of what the taxes are and have the money available, and then still have profit to be able to support yourself on top of that. Being self-employed is a fabulous thing. It gives you independence. It gives you all kinds of things, but you want to make sure you have all of the details and know what all the amounts are that have to be paid. In my experience, the vast majority of people who have problems are because they were not planning and they didn't understand the full picture about what taxes are owed and what has to be done. So with our small plate method, the profit first, like I said, get the book and read it. It has lots and lots of details in there, but this is a very high level overview of what it looks like. The money comes into the income account, and then you make allocations into these different bank accounts. And then all of your operating expenses, so like your credit card, if you pay for things on a company credit card, the company credit card gets paid from this operating expenses account. And then when you're putting a percentage away for income taxes every time you get some income, that way you're sure that all the money that you need is there to pay the tax if you're paying quarterly estimates or at the end of the year when your tax return is done. And then the other great thing about this is somebody comes to you and says, oh, hey, I would like to get a new truck for the business. Can we afford it? You can go look and see, well, how much money is left in operating expenses, because all the rest of these are earmarked. And so how do I know if I have enough to be able to go buy, a new piece of equipment or an additional expense? you would look at the operating expenses account and say, oh yeah, that balance has been building up. I already know how much I need to leave in there to have my month or two of, for the rainy day fund. And so I can say, yes, there's some additional money in there, we can go buy it, or no, we can't. And instead of having all of your money in one bank account, and what often happens, what happens so often with especially small business owners, is you have one checking account, and then you go to look and see, oh, do I have enough money to buy something? Well, yeah, there's extra money in my bank account, but everything's together. And so guess what? Now I don't get to take a paycheck because I already spent it over here on this other thing when I really didn't have the money for that. And so you can't really make educated, well-informed decisions about your finances if you don't have a knowledge of this information. And then the other thing that's important to note about this small plate method is making sure that you're updating these percentage, the percentages to distribute to each of these accounts regularly. And so another way to do this, if you know you're going to have a major piece of equipment that's coming up, you can also set up what's called a drip account. And so you might only put 1 or 2% of your gross income into that account each time, but you'll be amazed at how quickly it builds up in that balance. And then you know, okay, I'm going to have a bigger thing that I have to pay for in a few years, but it'll drip into that account, and then you can pay cash for it instead of financing it. And then that keeps your operating expenses lower because you don't have as much interest to pay. And you get, it's just a very well thought out, proactive method for making sure that you are budgeting correctly for your items. And then as businesses, we all know that when you own your own business, it is not a fix it and a set it and forget it type of entity. They're very organic, they grow and change. And so you just want to make sure you're keeping up with this information. Don't just set it once and then say that's what it is forever. You need to update and change and redo some calculations periodically to make sure that they're still accurate. Okay, that's the end of the slides, and I want to, now I have a couple of practical examples for you, if I can figure out how to get out of here. There we go. Okay, so I have a couple of worksheets that I want to share with you guys, and I will send copies of these to the lovely ladies over at the Business Center, and so that they can share with you, let's see, so that you can start using them as well and have this information to use. Is this big enough that everybody can see it? Hopefully.
We can't really see it yet. We just see the last slide.
Oh, you're still seeing the last slide?
Yeah.
Okay. Should be sharing. How about now? Are we getting the spreadsheet?
No, I would say probably like stop the sharing and start again.
Oh, yeah, it looks like I froze. Hang on, let me be sharing and then I'll start it up. Uh-oh.
If you want, I can stop your sharing so that you can share again.
Yeah, if you can do that, that would be great.
Okay, try that again.
Can you hear? Can you hear me? Sandra?
I can hear you, but I don't see you.
Okay, yeah, I think you have to make me host again. I had to bail out
Okay.
about that. It froze. There we go. Okay, sorry about that, everybody. Little technical
Perfect.
difficulty. Okay, so let me share my screen and. Okay, how about now? Can you guys see the spreadsheet okay?
Yes, we can now.
Okay, perfect. Okay, so this is a budgeting worksheet. It's pretty straightforward. And it just has, basically you start with all of your income and expense accounts from your chart of accounts. And this is one that would have cost of goods sold. Your specific company might have different accounts. Looks like we've got a question. Well, okay, we'll cover some questions here in just a second. I don't know, it looks like somebody raised their hand. I don't know, are we allowed to, or are we able to? Let's see. Raquel, are you there? Can you hear?
Yes. Can you hear me?
Yes, did you have a question?
So I absolutely love worksheets. So I was wondering if it's possible for you to share that worksheet with us.
Yes, I will send, so I'm gonna send these, all three, I've got 3 different spreadsheets that I'm gonna show you, and I will
Awesome.
send copies of them to the lovely ladies over at the Business Center. And
Awesome. Thank you so much.
so that they can post them, yeah, and
Okay.
share them with everybody.
Great.
Thanks.
Thank you.
Raquel, I'm sorry, this is Sandra. If you don't mind, put your email address. I'll forward up to you.
Okay, great. Okay, so we've got this budget worksheet here that you can use for your information. If you use a program like QuickBooks or any other accounting package, they probably have a budget module in there. I know QuickBooks does, and I would assume most of the other ones do as well. And the lovely thing about doing it within an accounting package like QuickBooks is that you can tell it to start with last year's financials, and then you don't have to pull up that information. It just will put it in there automatically, and then you can go through and edit that information. And in this spreadsheet, so you can see we've got different columns for each month. And then any of the shaded areas have formulas in them where it's going to calculate the totals for you automatically, so you can see where things are at. And so you can go in here and play with this and, you know, just add different information to see what does this look like. And then you can play with the different expenses to say, oh, what happens if I, you know, start adding different information, or I want to add another employee and I know that I'm going to pay them, you know, $2,000 a month gross, and you would add in their if they have any employee benefits or their payroll and their payroll taxes, all of that information you can add in here. So you can actually play with this and do kind of a what if scenario, in addition to just having good information and say, okay, this is my goal, or I started with last year and I want to make sure that we have an increase of 15% every single month over last year. And then once you have the budget, it's not enough to just create a budget. You have to actually do something with it. So here again, this is where having the budget in a program like QuickBooks or some other accounting software is handy, because then you can print a report that does a comparison of what is my budget compared with my actuals, to see, am I on track? Or am I behind? And if I'm behind, what do I need to do to analyze to either get myself where I want to be, or, you know, maybe decrease expenses? Okay, my sales revenue wasn't as high as I had hoped or had budgeted. So what costs can I cut now to make sure that I'm still going to be okay? And then, if you're not making your budgeted sales goals, then you maybe want to look at, do I need to do more advertising? Is there other information that I can put into play to either increase the sales? Or maybe one of the things you discover on the budget is, I know that my vendor who provides all of the materials for me to make my widgets is going to be increasing their costs by 10%. So how much do I need to increase either increase my sales or increase my prices to make up for that, so that I can still continue to cover all of my fixed costs and have the profit left over at the end of the day. The budget worksheet has some other information down here at the bottom. So debt service, keep in mind that debt service does not show up, excuse me, on the profit and loss statement, except for the interest portion of it. So if you're making payments on, if you got one of the EID loans during COVID, or you have a line of credit, or you got other loans that you're paying off a vehicle, a company vehicle, all of that information, you need to take that into consideration for your cash flow and make sure that you are going to be able to cover that debt service and make those payments. And then down here at the bottom is where we're talking about your shareholder distributions. So tax escrow. This is the amount of tax that our marginal tax rate that we talked about a little while back. And to make sure that you've got enough to cover any income taxes. And then as well as your savings amount. If you're working on building up your 2 to 3 months or 3 to 6 months worth of operating expenses, then maybe you want to put $50 a month into that, and start small. It doesn't have to be huge. If you're coming up, your budget is coming up tight and you're not quite having enough cash flow needs, start by just putting, 10 or 20 or $15 a month into this cash reserve. And at least then you're putting something in there, and you'll be surprised at how quickly that grows. Okay, so this is a really good, it's just a basic budget worksheet, nicely laid out. And so we will definitely save that, share that with you guys. And then let's look at, so this is a forecast. So a budget and a forecast are a little bit different. So a budget is, what do I expect income and expense wise in the next 12 months typical. Sometimes we do more often than that, but most typical is going to be a 12-month budget for the next year. And then you compare, what did I actually do with that? The forecast is typically over a longer period of time. And so with the forecast, we might do 2 or 3 year forecast. And this is going to be, here are my actual numbers for last year. And then just pick a percentage that you expect it to increase. So we often see this if a business is going after maybe venture capital funding, or even a loan from the Small Business Administration, other places, where they want to know, okay, what kind of growth do you expect to have in the business? And hopefully, if you're a successful business, you're not stagnating and there would be continued growth. The sign of a good, healthy business is that it does have growth year after year. There are a lot of businesses that purposefully keep their business from growing a lot, which is fine. There's nothing wrong with that. But you just need to be aware of the fact that you are doing it on purpose, and that you could be growing, but you choose to keep it at a particular level. And so then with the forecast, it just takes the percentage, whatever percentage you put in here for the increase, and then does a calculation based on actual. So that gives you your little projection forward. And then you might use this to feed into your budget, which would have all of the detail information by month. And then the last sheet that I want to talk to you about, so this is an even more detailed sheet that is, this is a 12-week rolling cash flow. And this spreadsheet, if you like spreadsheets, this is a good one for you. It has a lot of details and is very intricate. Has a lot of pieces to it. So I'm gonna actually, so the first page is a summary. So this one, you probably want to keep up at a minimum of a week on a weekly basis. This you can see has dates that get updated, and it goes out just 12 weeks. And so if you don't keep this up pretty much every week, in 1 or 2 weeks, you're going to be way behind, and it'll be a lot harder to keep up with this. So I'm actually going to start this one a little bit backwards. So you can see there are multiple tabs across the bottom, and you basically go in and you put in all of your information about your finances into here. And then it helps you with a cash flow to see, am I going to have enough cash flow to cover my needs? Which I will show you on the last sheet at the end of the day. So we have a recurring tab. So on the recurring tab are all of your recurring expenses. So if you have employees, the net payroll amount is going to be there, payroll taxes. So all of your payroll information is up here. If you pay health insurance and retirement contributions, that information might be up here as well. And you can see that we have different columns. So this column here is for the frequency. And so depending on how you pay your payroll, if your payroll is paid every 2 weeks, then that would be biweekly. It could be if it's semi-monthly, the spreadsheet isn't really set up to handle semi-monthly. However, it's if you just use the biweekly, that it's close enough. And you just have to make an adjustment every once in a while. And then we have a place for monthly taxes, and you can also do quarterly payments as well. And then things like rent. So these are going to be our fixed, most of this stuff is all going to be our fixed expenses that we were talking about earlier. Our rent we pay at the beginning of each month. And then we have insurance. In this case, there's renter's insurance, workers' comp insurance, and health insurance for the employees. If you pay an accountant to do bookkeeping for you, utilities, office cleaning, telephone, etc. Okay. And then you put in this column, you put the day of the month that the item is paid. And then, so if I update this and I make this the 15th instead, you can see the numbers shift, and these are all calculated with very fancy formulas to calculate out. Okay. So those are all your recurring expenses. Then we have, on this page, we have all of our payables. So these are the non-recurring expenses. So these are things like I have to pay it once, but it's not necessarily going to be paid every single month. So on here we have the credit cards are paid monthly, but the amount varies. So typically, if you pay off the full credit card balance, which hopefully you do, every single month, then I just put an estimate on this sheet of what the average balance is usually. And then as you know, you get the specific credit card, then you can fill in the actual amount for that. Same thing, workers' comp. So then in this case, we also have some subcontract payments that are in here. So we know that we've got a couple of big things that are coming up. And this will be listed as to when they're going to come due. If we had another piece of equipment that we know we have to buy, we can put that in here. Once we actually have the bill, there's a place to put the bill number, the invoice date, And then, but you can also put in here estimates. If we know we're gonna have to pay for a $50,000 piece of equipment. And it's gonna be due in September. Then we can put that in here, and then that takes into consideration, it puts it out here for that estimate. Okay. And then on this tab, this is where we have our income. So you can put in here if you know, as you have actual invoices, then we would put those in here with an actual invoice number and the dates. In this case, in this example, this company has long-term contracts. And so we know we're going to be receiving certain payments over this period of time, even before they've actually been billed. We don't actually bill them until they come up to those dates, but we can put in here estimates of what we expect to be coming up in the next period of time. If you do not have long-term contracts and you just have more like average sales, you can also put in here, like if you have a retail store, for example, then you might just figure out what your average sales are. And you want to make sure you're realistic about it, but you can put it in here as a different line item and just do all of your customers together as average sales, and then whatever the estimated amount is, you would put here, and then the due date would be, you know, if it's average sales per week, you would just put it on here. And then as they come to fruition and it's the real numbers, you can update the spreadsheet with the real numbers for that week. And then, so once you get all of these fancy pieces put in here, you can see that it all gets summarized on this nice little spreadsheet here. And it says, okay, so this is the current week that we're in and what the actual numbers are. So this column would be actuals. And then we've got projections in each of the following weeks out to 12 weeks. And so you can see here, they say estimated, and it actually has a nice little graph for you as well. If we were to change this, so that, let's see. So if I put in here that this was a $500,000 payment and it's actually going to be due in August. And then we go back to our cash summary, you can see that if you go into the negative, it's going to give you a big red flag and it's going to warn you, hey, look out. And we'd far rather know in June that we're going to have a problem in August and September than waiting until August and September and then being surprised because we have cash flow shortage and now we're scrambling. If you've got 12 weeks to plan or even 8 weeks to plan for it ahead of time, then you can try to do something about it. There. So on our summary page here, you can see we start with, so the beginning cash balance is taken from the prior week. This is what we actually have in cash. And then it projects where you're going to be at the end. And then in this case, we have a prior week actual, prior week estimated ending cash balance as well, so that we can see if something changes in a big way, then we want to know why. Okay, what happened on the sheet? What did we add in here that made such a big difference that we might want to take a look at? And then on this row, you can look across and see, sorry, on row 37 here, are we going to be okay? I'm just looking at our cash balance. Yep, cash balance looks like at least for the next 12 weeks, we're in good shape and we're okay. And just like on the budget sheet, you can also, if you save this out with actual information, then and have your current operating one, you can also make a copy of it and then play with some what if scenarios. So what if I want to hire a new employee? What does that look like? And so then you would go to your recurring and say, okay, I know that I'm gonna hire a new employee that's gonna add, $2,000 to my payroll expenses. And so you can go in here and play with the numbers and add an additional, $2,000 on there and say, where does that put me? And what does that do to my cash flow? Does that mess me up? I want to buy a new piece of equipment and that's going to mean debt service. So add in that information, play with it and say, okay, well, at least for the next 12 weeks, we're going to be okay with that and should be fine to do that. So there's a lot of detail in here. I didn't get too much into the detail, the day-to-day, like how you actually would use this spreadsheet. For the most part, it's very similar to the other spreadsheets where there are calculated fields. And so if you see a formula in the field, then that's a calculated field and you don't want to pretty much mess with those. They come from other tabs. And there also is actually an instruction page here. So if you want to read through all of the instructions, you're welcome to do that. It's got a lot of details in there as well. But you can also just play around with the spreadsheet and it can be a very, very useful tool. This has a lot of detailed information. And so this is probably overkill for a lot of business owners. If you're a very small business owner, you probably don't need all of this. However, if you want to use it, and even if you're a fairly simple structure, it can still come in handy and give you a lot of insight into your business and your operations. And if you're updating this, or if you're having somebody update it for you on a weekly basis, they're going to be very intimate with the knowledge of your finances and making sure that you know what's coming up. It keeps everything in the forefront of your mind. I think that's what I have to share today. Do we have any other questions? Let's see.
Thank you so much, Teddy. And I'm sure you'll send it over and I'll send it all attachments and the presentation to all those that are here, but then also all that have registered as well. And of course, this will all be posted to our YouTube channel by tomorrow. So that way you can go back to it and review everything that Teddy has shared.
Wonderful.
Thank you. Thank you. I don't know if there's any additional questions. But we're so grateful for your time, Teddy. This has been a very instrumental and informative. So thank you. Thank you. I did want to remind everyone that not only her webinars are recorded and posted to our YouTube channel, but if you also want one-on-one time with Teddy to go over your own books and see how things look and make sure everything is set up in a correct manner, please send us an email. You can send me or Sophia an email. We'll make sure to find time to connect with Teddy. Her spots, there's only 10 of them, and I think they're almost all full. So there's not many left, but feel free to contact us and we can figure out something. Okay? Well, thank you, Teddy, again for your time.
Sure.
Everyone have a wonderful Tuesday and a wonderful week, and we'll be in touch.
Sounds good. Thanks everybody for being here.
Thank you.
Bye-bye.
Bye.
Thank you.